Welcome back to Investing Talk Podcast.
Today we're looking at Marvell technology.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. For the past year, we've talked a lot about companies building the engines of AI. But the investment thesis around Marvell is fundamentally different.
How so?
It's about building the roads, the plumbing. It's the high-speed nervous system that connects all of those powerful engines. I mean, Marvell has really established itself as a foundational architect of this whole AI infrastructure era.
Okay, let's unpack that financial foundation first, because the numbers, they're not just showing growth. It feels more like an acceleration, like they're hitting some kind of critical mass.
That's a great way to put it.
They reported a massive Q3 for fiscal 2026. Record net revenue of what, $2.75 billion?
That's right. And that figure is up 37% year over year.
Which is just staggering for a mature silicon provider.
And that acceleration, it's laser focused. It's all about the data center. That segment is the absolute core growth engine, period.
Right.
It pulled in $1.52 billion in that same quarter. So that's roughly 73% of their total revenue.
Wow, so almost 3/4 of the business.
And that data center piece alone was growing at almost 38% year over year. When your core business is growing at that kind of clip, you have a really potent narrative.
And management clearly believes this isn't just a flash in the pan. They're guiding for full year fiscal 26 revenue growth to exceed 40%.
Which puts them squarely in that hyper-growth category, even at their scale.
Right.
But what's maybe even more compelling for long-term investors is the visibility they've given into the next year. They're projecting their key data center segment will grow more than 25% in fiscal 2027.
So this is a multi-year upcycle, not a one-off spike.
Exactly. The build-outs in AI infrastructure by the big hyperscalers, that's driving a really long runway.
What I find truly compelling is how this rapid growth is translating into, well, structural profitability. This isn't one of those growth at all costs plays, is it?
Not at all. Their gross margins are expanding, sitting at a phenomenal 59.7% on a non-GAAP basis.
Almost 60%.
A nearly 60% gross margin. That indicates serious technical differentiation. And, pricing power in their specific high-end niches, it signals defensibility.
And that strength flows right down the income statement.
It does. Their operating income margin is strong at 31.75%. And here's the kicker. Right now, their net profit margin is around 10%.
Okay.
But analysts are forecasting that as they scale, that net margin could move toward 20% in the next few years. That kind of margin doubling creates exponential shareholder value.
And the financial health underpinning all of this seems superb. They have an investment-grade balance sheet.
Yes, and crucially, they just got a huge cash infusion, $2.5 billion from selling their automotive Ethernet business.
Which was a smart pivot, right? Shedding a slower growth division to just double down on AI.
100%. And that cash is not just sitting idle. It's being deployed aggressively. They announced a massive $5 billion share repurchase program while also maintaining their dividend.
That share buyback is huge, though. If they have two massive acquisitions to integrate, which I want to get to, is spending $5 billion on buybacks really the best use of capital right now?
That's a fair challenge. I think in this case, the buyback acts as a confidence signal. Management is essentially telling the market, our stock is undervalued, and we have enough cash flow to execute our M&A and buy back shares.
So they see the integration risk as manageable.
Exactly. It suggests their internal roadmap is solid, making the buyback a clear capital allocation choice, not a last resort.
That makes sense. Okay, so the money is pouring in, the margins are fat. But let's talk about the moat. Why is Marvell positioned to win here long term?
Their moat is proprietary silicon combined with really deep software integration. They don't just sell, standard parts. They become an indispensable co-design partner.
And you mentioned custom ASICs, application-specific integrated circuits. That seems like the key lock-in.
It is. That's the first pillar of their moat. The hyperscalers, Amazon, Microsoft, Google, they all want their own proprietary AI chips to get an edge. Marvell offers the vertically integrated stack that lets them do that. They are the preferred design partner.
And we're seeing that partnership play out in cold, hard numbers.
Absolutely. The commitment is real. We know they're still crucial in Amazon's Trainium chip designs. They're also involved with a third Tier 1 customer, which we know is Microsoft.
And these are long-term design wins.
Yeah. These lock customers into Marvell's tech for like 5 to 7 years, and that lock-in is translating directly into some incredible revenue projections.
Go on.
Their Quantum AI ASIC revenue is projected to grow from around 1.8 billion this year to roughly double to 3.6 billion in fiscal 2027.
Doubling their most proprietary product line in 2 years. That's a powerful data point.
It's one of the most compelling parts of the entire story.
Okay, beyond custom silicon, let's talk about the specific networking products, the plumbing.
Right, they own the connectivity stack. This includes key growth drivers like their Golden Cable Initiative and the Alaska PCIe 6 retimers.
Hold on, for listeners who aren't in the trenches of data center design, what exactly is a PCIe retimer?
Think of it like a signal booster for data. At extremely high speeds, the signal degrades over a cable. A retimer is a chip that cleans up, regenerates, and retransmits that signal so it can travel further without errors. Marvell's dominance there is key.
So they control the reliability inside the rack.
Precisely. And their traditional switching business is still a monster. Data center switch revenue is expected to top $500 million in FY27 thanks to their advanced 51.2T switches.
51.2 terabits per second, just mind-boggling numbers.
And their Ethernet cabling and retimer revenues are doubling year over year on top of that.
Okay, now let's get to the M&A strategy. This is where it gets really interesting. They're buying capabilities. Let's start with the big one. Celestial AI for $3.25 billion. Why is silicon photonics worth that much?
Because AI systems are choking on copper cables. The data rates are so high that copper is becoming too lossy, it uses too much power.
So the old way isn't working anymore.
Not for the next generation. Silicon photonics means replacing electrical signals with light optical interconnects right on the chip. The Celestial AI deal just accelerates Marvell's roadmap there, ensuring they stay at the center of that transition.
And then, almost right after, they announced the acquisition of XCon for around $500 million. This is where we need to nail down the distinction.
This is the strategic masterpiece. Think of an AI data center as a city's water system. You have the scale-out network, that's the big municipal grid, the fiber optic cables connecting all the buildings. That's where Celestial AI's optical tech plays.
Okay, the big picture network. And the second part.
The second part is the scale-up network. That's the high-speed plumbing inside a single building, or in this case, a single server. That connectivity is handled by tech, like PCIe, and increasingly CXL switching.
And what exactly is CXL?
Compute Express Link. It's the fabric that lets multiple AI chips in a rack pool their memory together, acting like one giant unified brain. Acquiring XCon gives Marvell leadership in CXL, which controls that critical scale-up stack.
So Celestial is for the connections between servers, and XCon is for the connections inside the server. They're controlling the whole data flow.
Precisely. They are future-proofing their central role by owning connectivity from the chip level all the way to the network level.
Let's pivot to market momentum, because despite this explosive growth, the stock has been a bit volatile lately. Sounds like an opportunity.
It does. The recent price action, even with some underperformance, it looks like accumulation, especially from institutions who own about 83.5% of the shares. They're buying into this multi-year story.
And we've seen clear evidence of that. Kyreka LLC, for example, recently upped its stake by nearly 26%.
And that's backed by external validation. Moody's recently upgraded the company's senior unsecured ratings, signaling confidence in their profitability and tech portfolio.
So what are the immediate catalysts we should be watching that might trigger a re-rating here?
There are 3 critical near-term events. First is the CEO Matt Murphy's fireside chat at CES in January. People will be listening for any updates on the Celestial AI integration and, crucially, 2026 data center growth figures.
The deal's actually closing.
Yes, the Celestial AI acquisition is expected to close in the first quarter of 2026. It's expected to be accretive to margins right away.
And finally, the Q4 earnings report.
That's the big one. Late February or early March. It will confirm that full-year growth exceeded 40% and give the official guidance for fiscal 27. A strong report there could drive some serious momentum.
It all sounds incredibly bullish. But we have to look at the downside. What are the key risks investors need to keep in mind?
The biggest risk is concentration. Number 1 is customer concentration. Their AI revenue depends heavily on a few giant customers: Amazon, Microsoft, Google, Meta. If their spending slows down or one of them pivots their architecture, that could hurt.
That reliance on the big guys is a vulnerability. What's the mitigation?
The mitigation is that deep co-design partnership we talked about. It makes switching incredibly expensive and time-consuming for the customer. Plus, the acquisitions are designed to expand their footprint, reducing that single customer risk over time.
Okay, what about internal risks? This aggressive M&A strategy must have some.
It does. That leads to risk number 2, execution and integration. Integrating two big companies like Celestial AI and XCon at the same time is complex. If they fumble it, it could delay that margin expansion we're all expecting, that move from 10% toward 20% net profit.
But again, we come back to their financial health. How do they mitigate that execution risk?
By having a strong foundation. Their gross margins are already robust, around 60% non-GAAP, which gives them a buffer. The cash on the balance sheet means they aren't straining to fund the deals. And that $5 billion buyback, it's a signal that management believes their cash flow can handle everything.
So if we pull this all together, we have a custom AI chip and connectivity provider seeing massive revenue acceleration, backed by strategic acquisitions that basically protect their future.
The fundamental strength is undeniable. You have accelerating top-line growth, 37% year-over-year revenue, with 73% of that coming from the data center. You have expanding margins, and a proactive M&A strategy that gives them a foundational role in the AI interconnect stack. It's a strong, defensible position with clear catalysts ahead.
The narrative is certainly compelling. A foundational AI infrastructure architect that seems to have a valuation disconnect, despite soaring growth and perfectly executed connectivity strategy. If you want to stay on top of the latest analysis of companies defining the future of technology, make sure you hit that subscribe button.